Good evening, students. I hope you have revised the last class properly. So, what we had done in the last class, I'll just quickly recap before we begin today's class. We had discussed about in the last class section 112, and we had dealt specifically with sums on 112A itself, 112, 112A both. So, we had comprehensively covered that capital gain would be chargeable on the sale of listed equity shares or equity oriented funds, or for that matter units of business trust at the rate of 10% in excess of rupees 1 lakh. We had seen how the cost of acquisition is to be calculated if the shares are before 1 Feb 2018, right? Grandfathering benefits available. We had seen how to compute that cost. And then we had also discussed at the end about section 43CA, right? So in today's class, I'll take an extension to 50C. I'll discuss with you few more details about it. But just before we begin, if you have any doubts, you can ask me now itself with respect to the last class. Yes, Ambika. Your doubt is regarding section 45(5)(a). So for example, you are saying I have a land which I gave to real estate developer to build 4 buildings with 5 floors each. In consideration, you got 1 building which you sold before the certificate of completion. In this case, how would you allocate the cost of acquisition? Yeah, I'm just answering the query. So, Ambika, your doubt is with respect to the similar kind of question which we had done it there? Or what is it exactly? I'm not able to understand it properly. Can you repeat? I mean, can you elaborate your doubt, Ambika? Like what exactly a cost of acquisition you are asking? Good evening, Anjali. What is exactly the doubt, Ambika? Could you elaborate once? Meantime, I'll just share the screen. Ambika, you're asking cost of acquisition of the one building which sold before the certificate of completion. Yeah, Ambika, so in that case, you will have the cost what you have it, like what is the cost of your land, right? Because here what you have done is you have sold it, your land, right? So in that case, your FVC will be stamp duty value as per section 50C, right? Because in that case, 45(5) will not be applicable. But the cost of acquisition for that will be a normal cost, right, Ambika? Is it clear, Ambika? Because this is sold before the certificate of completion. Any other doubt? Just give So sorry. Yes. Because you're asking, but the real life cost of land would be different than the cost of construction. Yes, Ambika, you are true. It's true that the real cost of the land, here we are asking about building, right, Ambika? It's not about the cost of land. So here in this case, what you're getting is first of all the building, right? And then that building you would be making the sale to. So first your capital gain would arise in which case when you are selling the land. So see, Ambika, I'll explain you. Understand this thing. So first, there are two transactions. Don't mix up the transaction. First is when you transfer your land, right? And in consideration, you get the building, right? This is the first transaction. And then you are entirely selling up your building, right? So in the first case, when you will transfer your land and when you get the building, so there 45(5) is what? That it will be taxable in the year in which certificate of completion is issued by the competent authority, right? For the building. And FVC is what? The stamp duty value as on the date of completion certificate. Correct? Here you are saying you have transferred the building before the certificate of completion. So there 45(5) will not apply, right? So in that case, what will be applicable? Your FVC will become SDV as per normal provision, as per 50C. So here, what is the SDV for? Here, SDV is for the building received, right? And here your cost of acquisition is your land cost, right? Cost of acquisition is the land cost, correct? Now your query is, what about the cost of this building, right? So for that, here what you will do is, you will take FVC, which is the stamp duty value of building again, and the cost of acquisition technically will be this amount itself. Are you getting that? Because this has been already taxed, right? So here you are taking the SDV of the building received, which you're already taxing it. You have paid only the cost of acquisition of land. Again, when you are selling your building, right? The same event, here the two events are getting clubbed. Right? So this event is happening in which year? This is happening in the year when the building is sold. Before completion certificate. Are you getting that? So in this particular case, the completion certificate has never been received. And before the completion certificate is received, you are selling off the building. So ideally, you are not getting the entire unit of building, right? Ideally, you're not getting the entire unit of building, which could be value. So whatever the SDV you would get, you will tax that SDV, which would be of land and building combined. And the cost of acquisition, you have only paid the cost of the land, right? So in this case, the second transaction is not happening. So therefore, this will be your cost of land, the actual cost. Clear, Ambika? Because you have not paid anything as such for the building. And if I extend this transaction, if I take these transactions as two separate transactions, then in that case, the full value of consideration will be your SDV of the building or the actual consideration if it is more. And the cost of acquisition will be the cost which is already taxed here. Right? If you consider as two separate transactions. And there could be a difference in this only if the actual consideration is greater than the STV. Then you will have some amount of capital gain. Then this SDV of building as on this date will be your SDV. Is it clear? Shall we proceed further then? Ambika, are you clear with it? So today we are going to go a little further in section 50C. Now, what does 50C says? We had done it yesterday. That if the sale consideration is less than 110% of the stamp duty value, in that case, you will take your actual sale you will take the SDV, right? If you will take your actual consideration, but if your SDV is greater than 110% of actual consideration, then you will take full value of consideration as your SDV. We had seen if the date of agreement and the date of registration are not same, then SDV as on the date of agreement shall be taken if the amount of consideration is received by an account paid check on or before the date of agreement. Correct? So this is what we had done in the last class. Now a little bit extension of that. So there are some different situations. Say for example, where the assessee accepts the value adopted by stamp duty authority. In that case, the value adopted by stamp duty authority is taken as FVC. These could be important from your some point of view also, or also from MCQ point of view. Where the second situation, SSE has disputed value adopted by stamp duty authority. Then in that case, the stamp duty valuation as finally accepted for stamp duty purpose is taken as FVC. Right? And where the assessee claims that value adopted by stamp duty authority is more than FMV, but has not disputed the valuation, then FMV determined by the DVO is taken as FVC. The valuation officer, FMV determined by district valuation officer, is taken as FVC if it is less than stamp duty valuation. or stamp duty valuation will be taken. Stamp duty valuation is FVC if FMV determined by DVO is more than stamp duty valuation. Clear? Is it clear till now? Shall we solve one sum on 50C? Perfect, Ambika. Let's solve a sum on 50C. Find out full value of consideration for the purpose of section 50C. Case 1, stamp duty value 8 lakh on 10th April 2019. This is date of agreement. SDV on date of registration 8,70,000 30th April 2019. Amount as per agreement is 7,62,000. Date when first payment is received by check, by account pay check, 10th April 2019. Second case, 8 lakh 10th April 2019, 8,70,000 30 April 2019, 7,62,000 12th April 2019. Third case, 9 lakh 10th May 2019, 9,80,000 30 May 2019, 8,55,000 10th May 2019. Case number 4, 9 lakh 10th May 2019, 9,80,000 30 May 2019, 8,55,000 and 14th May 2019. And the last case, 10 lakh 11th April 19, 10,70,000 29 April 19, 10,20,000 14 April 19. So give me all the answers case by case. I'm giving you 5 minutes time to solve this sum. Give me the full value of consideration. Right, Ambika? Ambika, the second case is not correct. Yes, third case is correct. What are the answers? Quickly tell me. Only Ambika is answering. Right, Ambika? What are the answers, students? Yes, Ambika, right. The fifth answer is correct as well. What are the answers? Okay, let's solve it together. In the first case, what is the date of agreement? 10th April 2019. And when the first payment is received on or before the date of agreement. So in that case, amount as per the agreement is 7,62,000, right? Amount as per the agreement is 7,62,000. So therefore, what will be the amount? Here it is within the range of 10%, right? So amount as per the agreement will be taken 7,62,000. Correct? The second case, what is the date of agreement? 10th April. When is the amount received? 12th April. So it is received after the date of agreement. Clear? So whether we can take the date of agreement, the answer is no. We can take the date of registration. Correct? And the date of registration is 30th April 2019, right? And the amount is 8,70,000. So we'll take 8,70,000. Clear? The third case, date of agreement is 10th May. When the first check is received, 10th May. So we can take the date of agreement, 9 lakh. Amount as per agreement is 8,55,000. Right? So in that case, whether it is within the range of 10%, whether it is within the range of 10%. So what is the 10%, 110% of 8,55,000? Whether it is in the range, and this is less than 110% of amount as per agreement. So you can take 9 lakh. Clear? Is it clear? So in this case, in the next case, what is the scenario? In the next case, what is the scenario? We have received on 10th May 2019. Right? On and the date by when the first check is received. What is the first check? 14th May 2019, right? So whether it is before, the answer is no. So it is after the date of agreement. So can we take the date of agreement? The answer is no. Clear? So in that case, we will have to take the date of registration, right? And it is 9,88,000. Clear? The last case, 11th April 2019, and it is received on 14/4/2019. Again, it is received after the date of when the agreement was made, right? And here, this is 10,20,000. This is 10,70,000. So we can adopt 10,20,000. Is it clear? Is it clear? Any doubts with respect to this? Did you understand? Any doubts? So what you can do is you can make one separate column itself to identify. Here you can make one column itself in the exam. What you can do is you can write in this way. Stamp duty valuation. You can make date of agreement or registration. Stamp duty value. Right on that date. 110% of amount of consideration as per agreement. And your FVC will be if, so I'll number this column as 1, or I'll put it as like serial number as 1, 2, 3, and 4. Right? So FVC will be if 3 is more than 4. Then 3 will be taken. If 3 is more than 4, then the 3 will be taken. Otherwise, 4. So this way you can present it in your exam. Correct? Any doubts? Should I give you one more question? Is it clear? Yes, Ambika, it is appealable. Any doubts? Should I give one more question on this? Okay, let's solve one more sum. Let me pick the sum from your module itself. Give me a moment. Just give me a moment. So this is a comprehensive question. Let's try to solve this. Following are the details of income provided by Mr. Singh, the SSC, for the financial year ended 31st March 21. Rental income, standard rent, fair rent, municipal and water tax during the year, current year arrears, interest on loan borrowed towards major repairs to the property, arrears of rent received during the year which was not charged to tax in earlier year. Mr. Singh's father acquired a residential house in April 2006 for 1,25,000 and thereafter gifted this property to the SSC, Mr. Singh, on 1st March 2007. Property was sold by him on 10th June 2020. The consideration was 25 lakh. Stamp duty charges paid by the purchaser at the time of registration, 13%, was rupees 3,90,000. Out of the sale consideration received, he had purchased 2 adjacent flats in the same building and made suitable modification to make it as one. Investment was made by separate sale deeds, amount being 8 and 7 lakh. On 10th October, 10 lakhs were invested in bonds issued by NHAI. Compute the total income of Mr. Singh. Now, I do not need the full answer from you, but just tell me about the capital gain parts other than the exemption provision. So just give me the capital gain computation. You can just ignore the exemption provision as of now. So what will be your answer? Try to work out. What will be the answer in this case? Yes, Sumit, right. No, Raman. Okay, you're given only the capital gain. Yes, it's right, Raman. Yes, Ramya. Yes, Ambika. Yes. So let's try and solve together. What is the full value of consideration in this case? The FVC. How will you determine? So the stamp duty valuation they have given, stamp duty charges they have given is 3,90,000, which is 13%. Right? So in that case, stamp duty value would be right? 3,90,000 divided by 13%. That will be your stamp duty value. And what is the amount? 30 lakhs. Correct? And what is the actual consideration? What is the actual consideration given in question? The actual consideration given in the question was rupees. How much it is? 1 second. Mr. Singh acquired for 1,25,000 and thereafter gifted the consideration for 25 lakh, right? So 25 lakh. What is 110% of actual consideration? Whether SDV is greater than 110% of the actual consideration? The answer is yes. So stamp duty value is greater than 110% of the actual consideration. Because how much is your actual consideration? 25 lakh, right? And what is the 110? Any doubts? Ramya, stamp duty is not an expenditure. You get the deduction of stamp duty paid under ATC. So you cannot get a double deduction under capital gain. Ramya, so you get the deduction under ATC for the stamp duty paid, right? So when you purchase the property, you get the deduction under ATC. But when you are selling it, you will not get the deduction under the capital gains. Clear, Ramya? So when you purchase it, you already get the deduction under ATC. It is not an expenditure. Ambika, video is paused. Is it visible now? Okay, Ambika. Clear, Ramya? Any other question? Sorry. Any other doubt or any other question? Okay, so if there are no doubts, then what we will do is we will start with the amalgamation, demerger, slump sale, all of that reorganization part. Clear? So let's begin with that. Give me just one moment. Yes. So I'll call it as capital gains on reorganization of the businesses. Now we have already dealt with the computation part. Now let's go into the specifics of when the reorganization happened, how do the capital gain tax is carried out in those kind of transaction. So first I'm taking a transfer of capital asset by holding company, or let's put it like this, between holding company and wholly owned subsidiary. So when, say for example, this is the holding company, this is a wholly owned subsidiary. Now, when this holding company would transfer the asset to wholly owned subsidiary, or a vice versa situation, then in that case, this transfer is exempt under section 47(4), and the vice versa situation, that the transfer by wholly owned subsidiary to holding company is exempt under section 47(5). So if holding company transfers to wholly owned subsidiary, that will be exempt under section 47(4), and if wholly owned subsidiary transfers it to the holding company, then it will be exempt under 47(5). But these exemptions are conditional exemptions, meaning you have to satisfy certain conditions to get these exemption. Now, what are the conditions here? So, the primary condition, and there is a secondary condition. Correct? What is the primary condition? That the subsidiary company should be always a wholly owned subsidiary. It should not be the case that 50% is held, 51% is held, or 60% is held. It should be always 100% subsidiary. Second, the recipient company, holding company or subsidiary company who is receiving the asset should be Indian company. So the recipient company should be the Indian company. In the first case, this should be the Indian company. And when the wholly owned subsidiary is transferring to holding company, this should be Indian company. So when holding company is transferring to wholly owned subsidiary, this may be foreign company, but this should be the Indian company. When subsidiary is transferring to holding company, this should be Indian company. This may be foreign company. Clear? But in both the cases, it should be the wholly owned subsidiary. Clear? What are the secondary conditions? Subsidiary company shall not cease to be wholly owned subsidiary. What is the meaning of this? That it is possible to gain the exemption, the holding company might increase their shareholding. And suddenly after transferring the asset, reduce their shareholding. So it could be possible that if the exemption is available, this holding company, first it was say holding 51%, it will suddenly take over more 50% or 49% to create this as holding company, transfer the capital asset, claim the exemption, and then again sell off 49%. Which means that the only intention of doing that was to avoid the tax. And this company was never a wholly owned subsidiary. So therefore, this additional condition has been created, which says that the subsidiary company shall not cease to be a wholly owned subsidiary for a period of for a period of 8 years from the date of transfer. Clear? Second, the recipient company shall not convert capital asset into stock in trade. The recipient company shall not convert the capital asset into stock in trade. Clear? Is it clear? Any doubts till now? Any doubts till now? Are you understanding this? Any doubts? Okay, so if there are no further doubts, let's proceed further. Now, what if these conditions are not satisfied at any point in time? What if these conditions are not satisfied at any point in time? Then, what is the revocation? What will happen? What will be the consequences of that? Let's try and understand that. So, in case of revocation or violation of additional condition, so the primary condition, if you violate, you will not get any exemption itself. You are eligible for exemption only when it will be a wholly owned subsidiary or it will be an Indian company. Clear? But if you violate the additional conditions, what will be the consequences? Let's try and understand that. Now, what are the two additional conditions? Subsidiary company ceases to be wholly owned subsidiary, and the subsidiary company recipient company converts capital asset into stock in trade. Even for this, there is an 8-year timeline. Within 8 years from date of transfer. So what will be the consequences for this? Section 47A is applicable. For this, section 47A is applicable. What does section 47A says? That the condition or the exemption under section 47(4) or 5 will be revoked. And what will happen? The capital gain will be computed then. So what will be the full value consideration? So what will be the how the capital gain will be computed? Full value of consideration will be the FMV as on the date of transfer, as on the date when the transfer happened. So FMV as on that date will be taken as full value of consideration. Clear? Less cost of acquisition or indexed cost of acquisition. right? Cost of acquisition or indexed cost of acquisition. Then this will be, index cost will be CII for transfer year divided by CII in the year in which it was acquired. Clear? Is it clear? And that will give you the long-term capital gain or long-term capital loss. Is it clear? Now, if you sell this asset, now this is when the subsidiary company ceases to be wholly owned subsidiary. Then the exemption under section 47.4 and 47.5 will get revoked, and this will be your consequences, right? Now, what if the recipient company converts a capital asset into stock in trade? The recipient company converts the capital asset into stock in trade. In that case also, section 47A is applicable. 47A is applicable, and that will lead to revocation of 47.4 and 5. FVC will be FMV as on date of transfer less index cost of acquisition or cost of acquisition, right? Then long-term capital gain or short-term capital gain, whatever the answer will come. Clear? Same thing will be applicable. Now, are you clear with this till now? Before I proceed further, do you have any doubts with respect to this? Yes, Ramya, I'm coming to that point. I'm just coming to that point, Ramya. Hold on. Before that, do you have any doubt? Karthik, I didn't get your question. How the capital gain dealt if the transfer was made on the acquisition of ownership right? I didn't get your question properly, Karthik. What is exactly the question? I didn't get the question itself. Ambika, coming to that point. Just coming up to the point. I'm just waiting that if you have understood and if there are any doubts with respect to this. Any doubts with respect to this? Are you clear up till now? Up till this point? Okay. So if there are no further doubts with respect to this, let me proceed further. Now, understand one thing. What if now the sale happens, the subsequent sale happens of the capital asset which is acquired by the subsidiary company? So, of course, the exemption part will get revoked. There is no doubt about it, right? But what about the sale which is happening by the subsidiary? The subsequent sale which will happen by the subsidiary or the holding company, which is the meaning I'm saying by the recipient company, right? So in that particular case, what will be the consequences? Let's try and understand that. So if you sell the asset, if the subsidiary company or holding company subsequently sells the asset, then the full value of consideration will be your actual sale consideration less the cost of acquisition or indexed cost of acquisition. That will result in capital gain or capital loss. Whether in this case, now the question arises, you will club the period of holding of the previous owner, or you will take into consideration the period of holding of only the subsidiary company. What will be the period of holding of asset in this particular case? Whether you will club the period of holding or you will only take the period of holding held by the subsidiary company or the holding company. Just quickly give me the answers in your chat box. What do you think? What do you think? What do you think, and what will be the cost of acquisition in this case? Quickly in your chat boxes. That's what I've asked Sumit. What will be the cost in this case, according to you? Ambika, period of holding will be clubbed, you are saying. Right, Ramaya? So, you think that the period of holding will get clubbed. And what will be the cost of acquisition? What will be the cost of acquisition according to you? What will be the cost of acquisition according to you then? If the period of holding is clubbed, what will be the cost then? What will be the cost? Quickly tell me. Yes, Ramaya. Right. What will be the cost? Quickly tell me, please, students. Cost to the previous owner. So here, understand one thing. While you are saying that the period of holding will be clubbed, you are not correct. Here, period of holding will not be clubbed. And neither the Manjula Shah judgment will be applicable, which says indexation will be from the year in which the previous owner held the asset. That won't be applicable. As Ramaya, you correctly pointed out that here the revocation was already taxed. Here the revocation was already taxed. Therefore, the period of holding will be from the year in which subsidiary held the asset. So period of holding from year in which subsidiary held the asset. And cost of acquisition will be this. Because this has been already taxed. Is it clear? Did you get this? So why the cost to the previous owner will not be taken? Did you understand that? Did you understand that? So in case if the conditions are not complied with, then the exemption granted to the transferor first is revoked, and the transferor shall be chargeable to capital gains on transfer of capital asset in the year in which the transfer took place. And what will happen? Because say for example, the transfer happens in year 2014 and the subsidiary ceases to be wholly owned subsidiary, say in the year 2018. Then what will you do? You will not charge to tax in year 2018. You will charge to tax in the year 2014 itself, and his case will be reopened. His case will be reopened. Is it clear? And when there is subsequent transfer, then the cost of acquisition will be the full value of the FMV which was there on the date of transfer. Is it clear? Now let's proceed further. With respect to the second violation, recipient company converts the capital asset into stock in trade. What will happen in this case? Now, subsequent transfer by the subsidiary company or holding company. Now, Ramya and Ambika, very nice. You correctly pointed out the applicability of 45(2) here. Because this is conversion of capital asset into stock in trade. Right? So here 45(2) will be applicable. Correct? What will be the case then? Capital gain first. Right? Capital gain first in the year of actual sale of stock in trade. What is the full value of consideration? FMV as on date of conversion. Remember 45(2)? Cost of acquisition. What will be the cost of acquisition? What will be the cost of acquisition? This. The cost of acquisition will be this amount. FMV as on date of transfer. And the period of holding will not be clubbed. The previous owner's period of holding will not be clubbed. And so the Manjula Shah judgment will not be applicable. And then you will have PGBP, which will be your sale price minus the cost price. What is the cost price? What is the cost price? This. Are you clear with this? Did you understand this concept really well? Any doubts? Any doubts? Should I give you a sum to solve on this? So that you will get a better grip. Let's solve a sum on this then. So, A Limited holds 100% equity shares of B Limited. It has acquired land on 1/6/2010. 1/6/2010. The said land was transferred to B Limited on 30th June 2019 for rupees 15 lakh. For rupees 15 lakhs. B Limited transferred the land on 1st October 2019 for rupees 25 lakhs. Discuss tax implication. Discuss the tax implication in the hands of A Limited and B Limited. What shall be your answer? If B Limited converts the capital asset into stock in trade on 1st September 2020. FMV as on date of conversion was rupees 22 lakhs. Sorry. So give me the answer for this. I'm giving you 10 minutes time. Give me answer for this. Ambika, for revocation, the cost of acquisition is the cost to the transferor itself, because revocation is taxable in the hands of whom? The transferor, not the transferee. So there is no question of cost to the previous owner, Ambika. No, Anjali? Anjali, the conversion amount is right. No, Ramya. No, Raman. No, Sumit. Ambika, no. Anjali, no. Okay, let's solve it together. Let's solve one by one. Now, first is when original transfer is happening as on 30th June 2019. Right? On this date, the said land was transferred to B Limited. Now, whether this would be taxable transfer, answer is no. So, transfer by A Limited to B Limited is exempt under section 47(4). Why? Because both the conditions are satisfied, right? What are the two conditions? That this should be the wholly owned subsidiary, right? Which is the case. And there's no information given that A Limited is not an Indian company or B Limited is not an Indian company. That is not said. So we are assuming both are Indian company only. Right? So in that case, this is exempt under section 47(4). Clear? Now, on subsequent sale or transfer by capital asset by B Limited as on 1st October 19. Now, whether in this case the exemption under section 47(4) will be revoked, whether in this case the exemption will be revoked, what is your answer quickly in the chat box? No, Sumit. What is your answer? Whether exemption will be revoked on transfer of capital asset by B Limited? Quickly in chat box. Give me only that answer. Whether the transfer will be revoked. Whether the transfer will be revoked in that case. Very quickly. So in this case, on subsequent sale, the transfer will not be revoked under 47(4). The reason is that what two additional conditions, violation of two additional conditions will lead to revocation of 47(4). That the subsidiary ceases to be wholly owned subsidiary or the capital asset is converted into stock entry. There is no restriction on subsequent transfer of capital asset by B Limited, by the subsidiary. So if there's a subsequent transfer, the 8-year lock-in period does not apply. So therefore, there will be no revocation of 47(4). and it will be like a normal capital gain. So what will be the full value of consideration? At what price it has been sold? B Limited transferred the land for rupees 25 lakh. Right? Assuming SGV is less than 110% of actual consideration, because information is not given about SGV. So I'm assuming SGV is less than 110% of actual consideration. Then index cost of acquisition. What will be the cost to B Limited? So this is taxable in hands of B Limited. So the cost here will be the cost to previous owner. And what is that cost? What is that cost? 1 lakh. Since here there is no revocation of 47.4, therefore the cost will be to cost to the previous owner. Because if there would have been revocation, then the cost would have been the FMV. But here there is no revocation. So therefore it will be an exempt transfer, and therefore it will be the cost to the previous owner. 1 lakh into CII of the year of transfer, which is 289, and CII of the year will be the year in which the asset was first held by the previous owner. So therefore the period of holding shall be clubbed, and Manjula Shah judgment will be applicable in this case. So which is 137. It comes to 2.109. Right? So the long-term capital gain will be in this case 22.891. Is it clear? Did you understand? So Anjali, did you understand? Here it is not the case where 47.4 will be revoked. Clear? Next part. So this is the first part of the question. The second part of the question says that if the capital asset is converted into stock in trade. Here, if within 8 years, capital asset is converted into stock in trade, then there is revocation. So revocation of 47.4 will happen. Section 47A says that. Since within 8 years, the capital asset is converted into stock in trade. So in the hands of transferor A Limited, the exemption shall be revoked and the capital gain will be full value of consideration. Full value of consideration will be what? What is the full value of consideration? So as on the date of transfer, considering the FMV is this only, because the said land was transferred to B Limited on 30 June 2019 for 15 lakh. There is no information given about FMV as on the date of transfer. So assuming FMV is equal to sale consideration 15 lakh, right? Minus indexed cost of acquisition 1 lakh into 280 in the year of transfer divided by 137. Right? It comes to 204,380. So long-term capital gain in the hands of A Limited would be 12,95,620. Clear? In the hands of B Limited, in hands of B Limited, section 45(2) will apply. 45(2) will be applicable because conversion of stock in trade, conversion of capital asset into stock in trade is a taxable transfer under 247. And the capital gain as per 45(2) will apply. So what will be the full value of consideration? What will be the full value of consideration in this case? FMV of the capital asset as on the date of conversion, right? What is the FMV as on the date of conversion? 22 lakhs. Correct? Minus cost of acquisition. What will be the cost of acquisition? This 15 lakh. Clear? This will be short-term capital gain, which will be 7 lakh. Is it clear? Here, it will not be the cost to the previous owner because the exemption has been revoked. So the cost of acquisition shall be the cost to the assessee himself, at what price he would have sold him, right? And not the cost to the previous owner. Clear? In fact, the period of holding will also not be clubbed. Indexation will not be granted. Manjusha Shah judgment will not be applicable. And your period of holding is less than 24 months. Correct? So therefore, it's a short-term capital gain. Clear? Then there will be PGBP also. So sale price. What is the sale price? What is the sale price? 25 lakh. Minus cost, which is 22 lakhs. So therefore, PGBP will be 3 lakh. Is this clear? Any doubts with respect to this sum? Yes, Ambika, it was transferred for 15 lakhs. Sumit, in this case, A Limited has transferred to B Limited on 1 June 2019. And on September 2020, B Limited has converted into stock in trade, right? On 1st September 2020, B Limited has converted into stock in trade. So within the period of 8 years of transfer from A Limited to B Limited, B Limited has converted into stock in trade, the capital asset. So therefore, 47(4) will get revoked. Capital gain will arise in the hands of A Limited, who is the transferor. And when the B Limited will sell that asset, in that year, the conversion of capital asset into stock in trade will get taxable in the hands of B Limited. Clear? Is it clear? So here, 25 lakh, I'm assuming as the sale amount of stock in trade also, right? So that is why I have taken sale price as 25 lakh. Clear, Sumit? Yes, Ramya, sorry, my mistake. The CII would be into 289 divided by 167. Yes, Ramya, you are correct. The CII is 167. Where you are saying Ambika 15 lakhs in the first case. Where in the first case you are saying Ambika? Ambika, where you are saying 15 lakhs? Students, are you clear with this concept then? Should we take a short break for this? Of 15 minutes? Before we get to the next part. So let's take a break of 15 minutes and then we get back. Ambika, when revocation does not apply, in that particular case, we are seeing the cost to the previous owner. So it is not 15 lakh because the exemption has been available. You have not been understanding the fact that the exemption has been given. So then it will be the cost to the previous owner. Right? So cost to the previous owner is what? 1 lakh. So then that will be taken into consideration. Clear, Ambika? Because revocation does not apply. So cost of acquisition will be the cost to the previous owner and not 15 lakhs. 15 lakhs will be when the revocation is being there, right? Clear, Ambika? So let's take a break of 15 minutes and then we get back. So students, let's proceed further then very quickly. The next I'm going to cover up is section 50B, slump sale. Now, what is this slump sale? Slump sale. So it means that a transfer of any undertaking as a result of a sale for lump sum consideration without values being assigned to the individual assets and liability. So you take up that undertaking with a lump sum consideration without assigning any individual value that this is the asset, this is the asset. At this value I'll be taking. So say for example, there is this company A. It has 2 units. Unit 1, Unit 2. Sorry, my screen was paused. So company A, Unit 1 and Unit 2. Say for example, it transfers its Unit 2 to company B for a lump sum consideration. Then in that case, it will be considered as slump sale, taxable under section 50B. Now, how the computation happens? The capital gain is sale consideration, which is your full value of consideration, minus cost of acquisition. What is the cost of acquisition? Cost of acquisition is net worth of that undertaking. Net worth of that undertaking. Now, how do you determine the net worth of that undertaking? So, net worth will be equal to book value of assets minus book value of liabilities. You will have to ignore revaluation. You have to ignore revaluation, and assets will be at WDV after reducing depreciation as per Income Tax Act and not as per Companies Act. You will have to ignore the fictitious assets. Clear? No indexation benefit available. No indexation benefit is available, and period of holding is to be taken as 36 months. If it is more than 36 months, then LTCG. If this is less than or equal to 36 months, then short-term capital gain. So this is very simple. Do you have any doubts with respect to this? Let's solve a sum on this, on slump sale. ICAI question on this. So this is the question. Measure Shriram Enterprises, a proprietorship having 2 units. Unit 1 is transferred on 1/4/2020 by way of slump sale for total consideration of 35 lakh. Unit 1 was started in 5/6. Expenses incurred for this transfer, rupees 38,000. Balance sheet as on 31st March 2020 is as under. So this is the balance sheet. They have given other information. Revaluation reserve is created by revising upward the value of building of unit. No individual value of any asset is considered. Other assets of unit 1 includes patent acquired on 1/7/2018, 80,000 on which no depreciation has been charged. Compute the capital gain. So I'm giving you 5 minutes time. Quickly tell me the answer for this. What will be the answer for this? Quickly tell me. What is the answer? Quickly. Very simple question. Yes, Sumit, perfect. Very quick. Quickly tell me what are the answers. What is the answer? Quickly, it's very simple sum. I'm waiting for your answers. No, Raman. Anjali, no. Yes, Ambika, perfect. So let's try and solve it together. So what does it say? What is the full value of consideration? 35 lakh. That is very clear. What is the net worth? Now let's try computing that. So first of all, we have to take the building of unit 1, which is 13 lakh, right? Which is the 13 lakh, right? And then machinery is there. So 13 lakh, out of that, sorry, we will reduce the revaluation amount, right? Because they say revaluation reserve is created for the building, which is of 5 lakh, correct? So then in that case, building will be 13 lakh minus 5 lakh, right? What is the other asset? Machinery. We have to take machinery 4 lakh, correct? Right? Then what is the third asset? Debtors. We have to take into consideration the debtors of 2 lakh, correct? And other assets which include patent for which no depreciation is charged. So other assets is worth first of all 2,50,000, right? And besides that we have patent. So first, other assets 2,50,000 minus 50,000, 2 lakh, and I'm considering the patent separately. Right? So patent 50K. Now they are saying no depreciation has been charged on patents. And the patents are purchased in which year? In 2018. And we are in 2020. So we will have to provide for depreciation for financial year 18-19 and 19-20. So depreciation at the rate of 25% for financial year 18-19, right? Which comes to 12,500. So WDV as on 1/4/19 will come to how much? 37,500 minus depreciation at the rate of 25% for financial year 19-20. How much? 9,875, 9,375. So the WDV comes to how much? 28,125. This is your WDV which you have to take into consideration. Clear? Then they are saying there is a liability of bank loan and trade creditors. So bank loan and trade creditors, we will have to reduce it. 70% is for unit 1 and 25% is for unit 1, the trade creditors. So accordingly, we'll take 70% of 4 lakh, which is 2,80,000 as the bank loan, less liabilities bank loan 2,80,000 and trade creditors is how much? 40%. Correct? Trade creditors is 40%, which comes to 87,500. Right? So therefore, what is your net worth? Net worth comes to 12,60,625. And what is your capital gain? What is your capital gain in this case? It is a long-term capital gain of 22,01,375. Right? 22,01,375. Is it very simple to solve? These questions are very, very simple. Is it clear? Any doubts with respect to this? Anjali, did you understand? Yes, Ramaya, you were correct. Clear? Shall we proceed further then? Okay. So let's move to the next part then. Amalgamation. Let's move to the next part then. Amalgamation. Right? So what happens is, say for example, there is A Limited, which gets amalgamates with B Limited. Right? So this is amalgamating company and this is amalgamated company. Right? Now, say for example, if this company during the course of amalgamation transfers the capital asset to B Limited, right? This will be exempt under section 47(6). This will be exempt under section 47(6). Again, this is a conditional exemption. What are the conditions to it? That all the assets and liabilities of amalgamating company becomes assets and liabilities of amalgamated company. Clear? First condition. Shareholders not less than holding 75% in value of shares in the amalgamating company becomes shareholders of amalgamated company. Clear? Is it clear? So what are the two conditions first? All the assets and liabilities of the amalgamating company becomes assets and liabilities of the amalgamated company. All the shareholders holding not less than 75%, shareholders holding not less than 75% of the value of shares should become the shareholders in the amalgamated company. Clear? So these are the two conditions which the amalgamation, to get it exempt, you will have to satisfy. Are you clear? Is it clear till now? So transfer of capital asset by the amalgamating company to the amalgamated company is exempt under section 47(6). Also, this amalgamated company should be an Indian company only. Clear? It should be an Indian company only. Is it clear? Clear till now? Next. Now, next very important part is that here if understand the shareholders of the amalgamating company. The shareholders of amalgamating company A Limited, right? They are transferring the shares in A Limited and getting in consideration the shares of B Limited, right? So transfer of capital asset is happening, so transfer is happening of shares of A Limited and they are getting in return shares of B Limited, right, as consideration. Or they might also get some cash consideration. So how will the capital gain happen? So shares of B Limited, which they get, and when there is a transfer of shares of A Limited, this is again exempt. This is again exempt under section 47. Right? This is again exempt under section 47. And when the cash is received for fractional of shares, you would have learned in accounts. For fractional of shares, you get the cash. That is taxable. So FVC will be your cash component. Cost of acquisition is your cost of the shares of A Limited. Period of holding is the shares of A Limited when you purchased. And so will the indexation apply. Now, what if I sell the shares of B Limited? The subsequent sale of B Limited shares, what will be the capital gain? FVC will be your sale consideration. Cost of acquisition will be your cost of shares in A Limited. So cost of shares of B Limited will be the cost of shares of A Limited because it was an exempt transfer. Are you understanding that? Also, the period of holding will be what? The period of holding will be the period of holding of B Limited plus period of holding in A Limited. Period of holding of B Limited plus period of holding of A Limited. This is explanation 1 to section 242A. Indexation, whether Manjula Shah judgment will be applicable? Yes. So it will be from period of holding of A Limited. Is it clear? Did you understand this? Any doubts? Any doubts? Any doubts with respect to this? Did you understand this concept well? Clear? Is it clear? Shall we proceed further? Now understand one thing. If there are no further doubts, let's move further. So here, understand one thing, that in case of foreign company, because this we talked about Indian company. So as I said, for Indian company, transfer of capital asset to Indian company, which is the amalgamated company, is exempt. Also, the shareholder's right in amalgamating company gets extinguished and he gets a share in consideration of the amalgamated company, right? So in that very case, what happens is your transfer becomes exempt in that case as well. Now the question arises, transfer of share held in an Indian company by amalgamating foreign company to amalgamated foreign company. So understand this. So your amalgamating company is, say, A. Amalgamated company is, say, B. Now this company gets amalgamated with this company, and in the process this company had interest or share in company C, which is an Indian company. So this asset gets transferred to this company, right? So transfer of a capital asset of a share held in Indian company by the amalgamating foreign company to the amalgamated foreign company. That will also be exempt. And it will not be taxable in India. So this will be exempt under section 47. It will not be taxable just because the capital asset is in India. So though the transferor and the transferee are outside India, but section 911 we had seen in international tax class, we had seen it says that if the capital asset is located in India, then it may be deemed to be capital gain in India, right? So therefore this exempts it, but again it's a conditional thing. What is the condition? At least 25% shareholders of amalgamating company should remain in amalgamated company. So what is the condition? That at least 25% of the shareholders of amalgamating foreign company must continue to remain the shareholders of amalgamated foreign company. And second condition is that there should not be any capital gain tax in foreign country where company is incorporated. Is it clear? These are the two conditions in case of a foreign company. Clear? Is it clear? Any doubts till now? Any doubts? Did you understand this concept? Okay. So let's proceed further then. So now the second thing is indirect transfer. The second thing is indirect transfer. What is that? What is that indirect transfer? So let's try and understand that. So say for example, instead of share in Indian company, it would have been share in another, say, foreign company, which has a subsequent share in Indian company. Remember indirect transfer class? the share of a foreign company is deemed to be situated in India if it derives value from India. Right? So any transfer in a scheme of amalgamation of a capital asset of a share of foreign company, but which derives its value substantially from shares of Indian company, will also be exempt if at least 25% of the shareholders of amalgamating foreign company must continue to remain the shareholders of amalgamated foreign company, and such transfer should not attract tax on capital gain in country in which amalgamating company is incorporated. Clear? Is it clear? Is it clear? Clear? Any doubt? So this is about amalgamation. This is about amalgamation. Any doubts do you have? Sumit, it is also in the 6C. It is also in the 6C. 6A has 25% shareholders requirement. 6C is for demerger, right? Any other doubt? Shall we proceed further for demerger then? If you do not have any doubts. Okay. So let's proceed further then for demerger. Ramaya, you are saying amalgamating Indian company transfer to amalgamated foreign company will be taxable. Yes, Ramaya. That will be taxable, Ramaya. Clear? Let's proceed further then. Demerger. Now, what happens during the demerger? One undertaking of that particular company itself is hived off, right? It's hived off. So demerger, what are the conditions for that? So say for example, there is this company A. It has unit 1 and unit 2. Now this will get demerged to company B. Right? So this will be called as demerged company, and this will be called as resulting company. Clear? Now, this is again the transfer of the undertaking is exempt. The transfer of the undertaking is exempt to company B. So, what are the conditions but for that? What are the conditions for that? All the assets and liabilities of demerged company become assets and liability of resulting company. The first condition is all the assets and liabilities of the demerged company should become assets and liabilities of the resulting company. Clear? The second condition is that the demerger should happen. The demerger should happen at the book value. So, sorry, the transfer should happen at the book value. So, the second condition is the asset and liability so transferred should be at book value, ignoring revaluation. So the assets and liabilities are transferred at the book value. Clear? The third condition, the resulting company issues shares to shareholders of demerged company on proportionate basis. On proportionate basis. Next, what is the next condition? Shareholders holding not less than 75% in value of shares in demerged company become shareholders of resulting company. Transfer is on going concern basis. And the last point is a resulting company should be an Indian company. Clear? A resulting company should be an Indian company. So all these conditions should be satisfied for the transfer to be exempt. Clear? All the conditions should be satisfied for the transfer to be exempt. Also, very importantly, even the shares which are received, right? So even the shares which will be received in consideration of losing up the proportionate rights in that undertaking will also become exempt. Clear? Will also become exempt. So in this very case, if the shareholder, so not only the transfer of capital asset by the demerged company to the resulting company is exempt, but transfer of share in an Indian company by that particular the interest in that company which is getting extinguished, if you receive in consideration the share, that will also become exempt. Clear? That will also become exempt. Is it clear? Clear? Any doubts with respect to this? So any transfer or issue of shares by the resulting company in scheme of demerger, if it is made for the consideration of demerger of undertaking, that will also be exempt under section 47. Is it clear? Any doubts with respect to this before we proceed further? Any doubts? So amalgamation and demerger are defined where? Amalgamation is defined under section 21B. I'll take you to the module for that. So see, amalgamation is defined in relation to companies mean the merger of one or more companies with another company or merger of two or more companies to form one company. The company or companies which so merge referred to as amalgamating company, and the company in which they merge is called as amalgamated company. And the conditions are given in section 21B itself. What does it say? All the property of amalgamating company immediately before amalgamation becomes the property of the amalgamated company. Second condition, all the liabilities shall become the liabilities of amalgamated company. Shareholders not holding not less than 3/4, meaning 75% in value of the shares in amalgamating company become shareholders of the amalgamated company. Clear? For demerger, it is defined in 290AA, which says all the property of undertaking becomes the property of the resulting company. All the liabilities shall become the liability of resulting company. The properties and the liabilities transferred by the demerged company are transferred in its books of accounts at the values appearing in its books of accounts immediately before the demerger. However, this will not apply where it is in accordance with ICDS, in accordance with the Ind AS, and where the resulting company records the value of the property and the liabilities at a value different from the value appearing in books of accounts. But it should be in accordance with the Ind AS. Clear? Resulting company issued in consideration of its demerger its shares to the shareholder of the demerged company on a proportionate basis. Also, very importantly, remember that, say for example, here in this case, if company B itself is a shareholder of company A, company itself is a shareholder of company A, right? So in that case, can company B issues the share to itself? So company A's unit is getting merged with company B unit, correct? Now, if the resulting company is a shareholder of the demerged company, it cannot issue the shares to itself. Correct? You cannot issue shares to itself. So who will be the shareholder of company A? Company A shareholder will be company B. So company B cannot issue the shares to itself. In that case, the condition will get exempted. Clear? What are the other conditions? The shareholders holding not less than 3/4 in value of the shares, that is 75%, become the shareholders of resulting company. Transfer of undertaking is on going concern basis. Is it clear? So these are the conditions for demerger and amalgamation. No remainder, amalgamated company or resulting company need not hold asset for specified period before subsequent sale. There is no condition like that. That was only for holding and subsidiary company. Clear, Ramaya? Also, for demerger, the same rules are applicable if say for example, there is demerged foreign company, another demerged foreign company, and they transfer the shares of Indian company, resulting company, then this will also be exempt. This will also be exempt. Again, the conditions are same of 25% shareholders and the demerger not being taxable in the country where it is incorporated. Clear? Same is for indirect transfer. If instead of Indian company, the shares are transferred of a foreign company, of intermediate company, again in that case, it will become exempt. So transfer of shares held in Indian company by demerged foreign company to the resulting foreign company, that is exempt. And the requirement is, not of 25% shareholder, but 35% shareholder. 75% shareholder. Exempt if 75% shareholders of demerged foreign company becomes the shareholder of the resulting foreign company. And the transfer is not exempt in the country in which demerged foreign company is incorporated. Clear? Similarly, for indirect transfer, if instead of Indian company, here it would have been foreign company, and the foreign company had the substantial interest in Indian company and shares are transferred of this intermediate foreign company, still it will be exempt if 75% of the shareholders are in the resulting company. Is it clear? Is it clear? Any doubts with respect to this? Sumit, I will explain. Don't worry about that. That is very simple. Cost of acquisition in case of income declaration scheme is the FMV which you take for taxability under income declaration scheme. Clear, Sumit? Okay, let's proceed further then. Now, what if the shares of the demerged company are sold or resulting company are sold? Then what will be the cost of acquisition? So cost of acquisition of shares of resulting company is not like amalgamation. Is not like amalgamation. Here it is different because here not the entire company is demerged. Only part of the undertaking is demerged. So part is still left with the earlier demerged company and part has gone to the resulting company. So you cannot take the cost of acquisition as the cost of shares of demerged company. Here cost of acquisition will be cost of shares of demerged company into net book value of asset transferred to resulting company divided by net worth of demerged company. So net book value of asset transferred to resulting company divided by net worth of demerged company. I'll explain you how to compute the net worth. Net worth here will be paid up share capital plus general reserves as appearing in books of accounts of demerged company immediately before demerger. Here the net worth calculation is different from slump sale. What will be the period of holding? Period of holding will be the period for which shares of demerged company were held and plus current period of holding. So there will be clubbing of period of holding. The period of holding of earlier shares will also be clubbed. Indexation benefit will also be applicable similarly. So Manjula Shah judgment is applicable here. Now, what will be the cost of acquisition? What will be the cost of acquisition of shares of demerged company? So that will be the cost of shares of demerged company minus the cost arrived here. The cost arrived here. So cost of shares of a resulting company as per section 49(2)(c). This is section 49(2)(c). Clear? Is it clear? Did you understand this? Any doubts? Is this concept clear? Any doubts with respect to this? Okay. If there are no doubts, let's proceed further. So this is about your demerger. Now I am moving towards the last part about conversion of sole proprietary concern into company. Sole proprietary concern into company. This is exempt under section 47(13). But again, it is a condition-based exemption. What are the conditions? First is asset and liability condition. All assets and liability should be transferred of the sole proprietary concern to the company, right? To the business of the company. Clear? Second, shareholding condition. Shareholding of the sole proprietor should be greater than equal to 50% of total voting power in company for a period of 5 years. So the sole proprietor should be holding more than 50% of total voting power in company for a period of 5 years. Consideration. Only allotment of shares in company. There should not be any other consideration. Clear? So these conditions should be satisfied to get the exemption under section 4730. If you violate any of the condition, under section 4713, then the exemption which is there will be revoked. The exemption which is there will be revoked. Clear? Is it clear till now? And what will happen subsequently if you violate the condition? Violation of condition will lead to excess of fair market value on date of conversion. So I'll write like this. FMV on the date of consideration will be a full value of consideration minus the cost of acquisition will be considered as capital gain. Will be considered as capital gain. This will be in the year of violation of condition. In the year of violation of condition. Clear? Is it clear? So conversion of sole proprietary concern into a company. Clear? Any doubts? Okay. Then conversion of partnership firm into company. Conversion of partnership firm into company. All the assets and liabilities of the partnership firm again should become the assets and liabilities of the company. Clear? So all assets and liabilities should become the assets and liabilities of the company. For the exemption to be granted under section 4740. Clear? The partners should hold greater than equal to 50% of total voting power in company for 5 years. Same. Consideration should be only allotment of shares. Clear? Clear? Then there is additional condition also. There is additional condition here also that all partners of firm become the shareholder in same proportion in same proportion as of capital in books of firm. So there is this additional condition that all partners should become the shareholders of the firm in same proportion in which they held their capital in firm. Clear? If you violate any condition, again, it will be capital gain in the year in which the violation take place, and FVC will be FMVA on the date of conversion, and the cost of acquisition will be reduced. That will be your capital gain. Clear? Third is conversion of unlisted company to LLP. Unlisted company to LLP. But before that, tell me, are you clear with this? Yes, I will explain, Sumit. I'm getting on to that only. Any other doubt which you have? So unlisted company or a private company to LLP. That's what we are going to do now. Any other doubt? Okay, so let's get on to that. So what are the conditions for that? Again, same condition. All assets and liabilities of the company will become the assets and liabilities of the LLP. The first condition. And this is exempt under section 47(13)(b). 47(13)(b). Right? So all assets and liabilities of the unlisted company will become the assets and liabilities of the LLP. And here any transfer of capital asset as well as shares held in a company by a shareholder on conversion of company into LLP, both will become exempt. Clear? What is the second condition? All the shareholders of the company immediately before the conversion become the partners of the LLP, and their capital contribution and profit sharing ratio in the LLP are in the same proportion as their shareholding in the company. So what is the second condition? All the shareholders become partners in same proportion as their shareholding. Clear? So all the shareholders of the company should become partners of the LP in the same proportion as they held their share capital. So the capital of the firm should be in the same proportion as that of the company. Is it clear? So all the entire capital contribution and profit sharing ratio in the LLP will be in the same proportion as the shareholding in company. Even the profit sharing ratio would be similar. Clear? Also, what is the other third condition? What is the other third condition? The third condition is that only share in profit and capital contribution is given as the consideration. There should not be any other consideration. Only share in profit and the capital contribution should be given. Clear? All the only share in the profit and capital contribution should be given. Next condition is aggregate of profit sharing ratio of shareholders of company in LLP shall be greater than equal to 50%, shall be greater than equal to 50% for 5 years. So the aggregate of profit sharing ratio of the shareholders shall be greater than 50% of the profits of the LLP for a period of 5 years from the date of conversion. So the shareholders of the company will be entitled to receive at least 50% of the profits of LLP for a period of 5 years from the date of conversion. Also, there are additional conditions in this. What is the additional condition in this? That the turnover, the total sales or turnover of the company in any of 3 preceding previous year in which conversion take place shall not exceed rupees 60 lakh. Shall not exceed rupees 60 lakh. Is it clear? So the total turnover of any of the 3 years shall not exceed 60 lakh in any of the 3 preceding previous year. Clear? What is the other condition? There is other additional condition to this, that book value of assets, total book value of assets of company in any of 3 previous year shall not exceed rupees 5 crore. The total book value of assets of company in any of 3 previous years shall not exceed rupees 5 crore. And the last condition is no amount should be paid. No amount should be paid to any partner out of accumulated profits of company on date of conversion for period of 3 years. So what are the conditions? All assets and liabilities should be transferred. All the partners or all the shareholders should become the partners, and in the same proportion as their shareholding. The profit sharing ratio will be in the same proportion. Turnover of company should not exceed 60 lakhs in past 3 years. Book value of the assets should be less than 5 crore. No amount should be paid to any partner out of the accumulated profits of the company on the date of conversion for a period of 3 years. And the partners should get at least 50% of the profit. Clear? Is it clear? Any doubt with respect to it? Now, what if you violate the condition here? So in this case, the violation is treated differently. So if you violate, the amount of capital gain exemption available to company will become income of LLP in year of non-compliance. Also, capital gain exemption to shareholders of company will become capital gain of partners in year of non-compliance. Clear? Is this clear till now? Any doubts? Did you understand this concept? Any doubts you have? If you have any doubts, you can ask me now. In the next class, what we'll be doing is we'll covering the exemptions part quickly, and then we'll be proceeding on income from other sources. So if you have any doubt, you can ask me right away before we end the lecture. Any doubts? Did you understand the concept? Okay, so if there are no further doubts, we can end the session here. So thank you all for today, and we'll meet on 19th and keep revising this entire because capital gain chapter, because it's very, very important from exam perspective as well. So see you all in the next class. Thank you so much.